after you've completed the recording of all of your transactions in your journal, and then that has been posted to your general ledger, then you're ready to do what's called a trial balance. Now let me just mention that with the advent of accounting computer programs, you probably aren't actually journalizing and posting. In essence, what you do with a computer program is you're doing the journalizing and the posting gets done automatically for you, kind of behind the scenes. But the next step after you've done that for a particular period, and like I said, we normally do financial statements at the end of an accounting period, which may be a month, maybe a quarter, definitely would be done every year for sure. But at the end of the period, you want to produce your financial statements. And before you start with that, you want to be sure that your accounts are in balance, meaning your debits equal your credits and that your accounting equation is in balance. And the way that we ensure that is happening is we prepare a trial balance. So in double entry accounting, you want to be sure that all of your debit accounts equal the sum of your credit account balances. So what you do in a trial balance is you basically just list all of the accounts and what their balance is. So as you can see here with the company that we've been working with, Fast Forward, all of their accounts are listed, and if it has a debit balance, you would list it in the debit column. If it has a zero balance, it's just zero. And if it has a credit balance, it gets listed over here. And when you add the total of your debits and credits, they should balance. Now, what order do you place these in? Generally speaking, you just follow the order that they are in your ledger. The 100 accounts come first, the 200 accounts, the 300 accounts, and so on and so forth. So, as they say here, this is how you go about preparing it. You list the title and its amount. You figure out what the balance of that account is at the end of that particular accounting period. Remember, in your ledger, you could have several entries for the month. So you would add up all your debits, add up all your credits for cash, and then figure out what your balance is for that particular account and whether or not that balance is a debit or a credit. So if you do that and it matches, this doesn't absolutely guarantee that you did everything correctly, because you could have your debits and credits correct, but you might have posted to the wrong account. But this is important because at least if you have debits and credits equal, then there's a pretty good chance that you probably have recorded things accurately. Now, if you find out that your trial balance is not in balance, then you've got to fix it. You can't move forward because you have to know where you've made the mistake and correct it. And this next section talks about how you might go about doing that. I'm going to let you read that for yourself. But let's go ahead and look at how you then use that trial balance to prepare your financial statements. Again, you're going to need to understand a little bit about the financial statements, which we talked about in Chapter 1. But you can, again, read this stuff for yourself in terms of understanding that. But the income statement, as we talked about in Chapter 1, reports all your revenues and subtracts all your expenses that are incurred in that particular period. So from that trial balance, you can look at it and you can pull out your revenue accounts, which were your consulting revenue and rental revenue, and then your expense accounts, which you have 3 of them here. And you would do your income statement based on here's the revenues, total revenue, and then here's your expenses. There's 3 accounts, total expenses, and then the net income is revenue minus expenses. Then your next report would be the statement of retained earnings. And remember, this company just started, so there was no retained earnings at the beginning of the period. The net income gets brought down from the income statement, and then you subtract from net income any cash dividends, which again, if you go back up to your trial balance, your dividends would be listed here on your trial balance. And so you subtract the dividends, and you end up with an ending retained earnings at the end of the period. Then when you go to your balance sheet, again, all of these accounts for the most part are going to be taken from up here on the trial balance. Remember, cash, accounts receivable, supplies, prepaid insurance, equipment, those are all assets. Those all go on your balance sheet because the balance sheet is assets, liabilities, and equity accounts. Accounts payable, unearned consulting revenue, these are your two liabilities. And then common stock is going to be your equity account. So if you come back down to your balance sheet, you've got all your assets here. You have your two liabilities here. You have common stock, but remember, equity is now increased by the retained earnings at the end of the period. The retained earnings has already taken into account the net income for the period and the cash dividends for the period. So this is the only figure you need down here. So once you bring that down here, then this side has to equal this side. It has to be in balance. But you can see where all of this can basically be done once you know that your trial balance is in balance. You have all the accounts you need here to begin work on your financial statements. All right. There's some other information here at the end of this chapter that you can read. Another thing that you should take note of here is how to compute a debt ratio, because we will be using that in some of the homework and calculations. But it's relatively simple. Debt ratio is calculated by taking your total liabilities and dividing it by your total assets. Most important thing here is really understanding what are liabilities and what are assets, but you can take those again from your trial balance or from your balance sheet and take your total liabilities and then divide it by the total assets, and that number that you come up with is what is considered your debt ratio. And we, as I said, we will be using that. Here's another example of that, and we'll be using debt ratio in some other transactions throughout the semester.